All right, so welcome to today's class, and today's class we're going to be talking about market structure. Now, it's at this point that you can see you have you have started learning how to trade. What we've been doing before, you are just learning about trading. We are not learning how to trade yet. So from this point or from this junction, you can begin to say you are learning how to trade because we are beginning to dive into what will make your trading. All right, so in today's class, we're going to be talking about market structure. We are in the phase 2 of this tutorial class. All right. Now, without no further ado, let's get into the business for the day. Now, on your screen, you can see some basic market structure illustrations. All right. On the left, we have an uptrend, which can also be referred to as a bullish order flow. Right on your left you have an uptrend, and then just as you know, an uptrend is made up of higher highs, higher lows, higher highs, higher lows, higher highs, and higher lows. All right, so for this higher high to form, okay, it went down, formed the higher low, and then for this higher low to become valid, it has to break above higher high, where we have a break of structure. All right, so the move that actually go past the previous high in an uptrend, okay, that move there is called the break of structure. All right, so we have the same thing here. Higher high formed higher low, it moved up. At this point we have a break of structure. All right, higher high, higher low, if it moves up at this point we have a break of structure. All right, so this is a theoretical example of a bullish market structure. And then on your right we have a downtrend, which can also be referred to as a bearish market structure. All right, and then a bearish market structure, we have a lower low, lower high, and then if this lower high engineers the move to break below the previous lower low, we have a break of structure. All right, so lower low, lower high, it moves below previous low, we have a break of structure at this point. Lower low, lower high, it moves below previous low, we have a break of structure at this point. All right, so that is a theoretical example of what of a downtrend. Right now, let us go into something more theoretical, something more real, something more relatable. All right, because you will not always see, all right, you will not always see price move so smoothly like that in your trading. Okay, so now basically we have a more realistic example of an uptrend and a downtrend. Okay, I sent an exercise few days ago, so this should not look new to you. All right, now so we have a more realistic example of an uptrend and a downtrend here. Okay, I sent an example and an exercise a few days ago, so this should not look new to you. Yeah. Now on the left, okay, you can see a break of structure right here, and then in between the higher high and the higher low that will form, we're going to also have some structural moves. Okay, in between the higher low, okay, after the break of structure to form the new higher high, we're also going to have some structural move. Okay, in between the higher high to the higher low that's going to form, we're going to have some structural moves. We're going to have internal highs and internal lows forming. Internal highs, internal lows, break of structure, internal highs, internal lows, blah, 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 break of structure. Yeah. Now, in a downtrend, you're going to have similar thing, just the direct opposite. Okay. Now, for the lower low to form, okay, we have a lower high, okay, a break of structure, guys. It forms a lower low, forms a lower high, forms a lower low, lower high, and then price goes on that way. Okay, now you must understand that the swing high is the highest point that caused the swing low. Okay, now this is what, okay, this is the highest point on this, in this case. Okay, this is a swing high, this is the highest point that caused this swing low. Okay, yes, no doubt this point here is a high, but this is not a swing high because this is not the highest point that caused this swing low. Yes, this high followed to cause the swing low, but it's not the highest point. This is the highest point, so this is the swing high. All right, now a swing low is the lowest point that caused the swing high. Yeah, now this is a swing low, it caused this swing high. This is the lowest point that caused this swing high. This low right here, yeah, is the lowest point that caused this swing high. Same thing, swing low, swing low, swing low. Yeah, this is the lowest point. Yeah, this is a low, all right, but this is not the lowest low. This is the lowest here, all right, and it caused this swing high. So we have this to be a swing low, all right. Now you must also understand that after a break of structure, okay, after price breaks structure, you should anticipate that price will do what? Will come back. There's going to be a pullback, a retracement. All right. What I taught you guys to be a corrective move. So after price does the impulsive, we're going to have a corrective move. Always anticipate that, okay? After price moves, break structure, we're definitely going to have price come back for a pullback or a retracement, corrective move, whatever you want to call it. But just know that price will shall come back. Get now, the next we're going to be talking about strong highs, yeah, and strong lows. All right. Now, in a downtrend, or should I say in an uptrend, first of all, okay, you must understand that the lows are protected. Now, when I mean protected, I also mean that they are strong highs. So I can simultaneously use protected and strong. All right. So if I say a strong high, I also mean a protected high. All right. So in an uptrend, all right, what happens in an uptrend? In an uptrend, only the previous highs get broken. All right. So in an uptrend, it means the lows are protected. We do not want to see the lows get broken in an uptrend. We only want to see the previous highs get broken. So if a previous low gets broken in an uptrend, then it signifies something, and we're going to come to that, right? So the whole idea of strong highs and strong lows, just know that in an uptrend, the lows are protected. The lows are strong, all right? The lows are strong. Now you can see I give the illustration for the ones that have the straight lines, it signifies strong highs and strong lows. Then for the ones that have the dotted lines, it signifies weak highs and lows. All right. So in an uptrend, the lows are strong and the highs are weak. Now, why are the highs weak? Because they are going to get broken, definitely. All right. We expect that the highs in an uptrend will get broken. So the highs are weak. Okay. Now in the downtrend is the direct opposite. Because in the downtrend, the lows are weak because, of course, we expect the lows to get broken. But in the downtrend, we do not want to see the highs violated. We do not want to see the highs get broken. All right. Now, this is a more realistic example. Okay. This is a more realistic example. Yeah. Now, uptrend. Okay. This is a more realistic example. All right. Now, only the lowest point. Okay. You must understand that only the swing highs and the swing lows, only the swing highs and the swing lows are protected or are weak, whatever. All right. So in an uptrend, only the swing lows are strong. Okay. In an uptrend, the swing lows are strong. Now, if you cannot hear me, type in the chat box. Don't unmute your mics, please. Now, in a downtrend, okay, in a downtrend, the swing lows are weak while the swing highs are strong. So in a downtrend, no one will see the swing highs get violated. Yeah. Now, if you are following me, okay, if you are following what I'm saying, please send in some emoji into the chat box so I know you are following me. If you are following me, drop some emojis into the chat box so I know you are with me. If you are following me, drop some emojis in the chat box. Yeah. If you are following me, drop some emojis into the chat box. All right, I can see you. Okay, okay, that's amazing. That's amazing. That's amazing. All right, so I still want to see more emojis, guys. I still want to see more emojis. All right, okay. It's amazing that all of you, all of you are following. Covenant is saying is lost. Covenant, okay, keep your questions. When I'm done explaining, then you can ask. Why is it saying my internet connection is unstable? All right, then, so let us keep on going, guys. Now, we're gonna be looking at something quite amazing next, yeah. Now, we're gonna be looking at trend change next. Trend change, yeah. We're gonna be looking at trend change next. Now, this basically, okay, is trying to show you that an uptrend changed to a downtrend, then changed to an uptrend, then changed to a downtrend again. Now, what are the things that can signify that an uptrend is about to change to a downtrend. Okay. Now I told you something. I said in an uptrend, okay, the swing highs are weak while the swing lows are protected. In a downtrend, the swing highs are strong while the swing lows are weak. Okay, so in a downtrend, we expect that the swing lows are going to get broken. Of course, yeah. Now look at your chart closely. I'm gonna give you like 1 minute, okay, to observe the chart. I'm gonna give you like 1 minute to observe this image you have on your screen. Read the annotations, read all these things in the boxes, all right? And then I'm going to explain. So you have like 1 minute to look closely at what I've drawn on the screen, what I've illustrated, and then try to break it down in your own terms. Then afterwards, after about 1 minute, I am going to explain. So I'm going to see you in 1 minute. All right, so I believe all of you have gotten a close look at this. Yeah. Now I'm going to be explaining. All right. And I really believe that if after the class, okay, I'll really love it if all of you send a picture of your notes because I expect that you guys are taking notes. Right? I'm still going to send this whole pictures to the group chat. Maybe put it in form of a PDF and send. And I'm still going to upload the videos because I understand that market structure is something you need to go over a lot of times before, okay, like few times before you were able to get a hang of it. Now, I want to now explain this whole chart that we have on the screen right here. All right. Now, looking at your screen, all right. From the left-hand side, we are coming from an uptrend. So, of course, in an uptrend, the swing lows, we are strong, and the swing highs, we are weak, okay? Now, look at this high. This high took out a strong low. This high pushed down price, and it broke a strong low. Now, at this point, at this point that we have a high taking out a strong low, it is referred to as a market structure shift, okay? Market structure has shifted from a bullish trend to a bearish trend. All right. So at this point, we have a market structure shift. All right. Then automatically, okay, in an uptrend, in an uptrend, the highs are weak. But as this high has been able to break below strong low, it automatically becomes a strong high because from this point we have the market become a downtrend. Okay, market has changed to a downtrend from an uptrend. Now, as price has formed this lower low, it goes up, and then as far as this high does not go above this previous high, above this higher high that broke previous low, it becomes a downtrend. Yeah. So we have what? Lower low right here. Now at this point, the highs become protected because it's now in a downtrend. The highs become strong, while the lows become what? Weak. Okay, so now the higher low, because normally when we have price break before above higher high, we expect what? A higher low to be formed. Now in this case, a higher low was not formed. Okay, our expectation of a higher low was not formed, and a lower low formed instead, confirming what? A downtrend change. Okay, so the downtrend continue, lower high, lower low, lower high, lower low, lower high, lower low. Now this low, which was supposed to be a weak low, okay, pushed price up. It broke below the lower high, which is the strong high, the strong swing high. Now, for this lower low to be able to break above the strong swing high, this lower low becomes a protected low. Yeah. Our expectation here for a lower high to form, it did not happen. Instead, a higher high formed. So an uptrend begins. So higher high forms, higher low, higher high, higher low. The highs become weak while the higher lows become strong. All right. So at this case now, a higher low, a higher high, all right, formed, and then it pushed down price to break below higher low. So this high, which was weak, automatically becomes a strong high because it has formed a new lower low. And from this point, we have a downtrend structure confirmed. Yeah. So I believe that makes sense. All right. That is what, or that is how you get to observe that okay, a downtrend has changed to an uptrend. Don't forget, at this point whereby we have lower low breaking above in a downtrend, breaking above a lower high, it's called the market structure shift, where the market has shifted from a downtrend to an uptrend. Market structure shift over here, market structure shift over here, market structure shift over here. All right. So I know that makes sense. I know that makes sense. Yeah. All right. So we're also going to talk about something again. Now we are going to be talking about internal market structure shift. Now you remember, I'm coming. Now we are going to be talking about internal market structure shift. Yeah. Now in between, I told you guys, I said this in earlier, I said in between that structure, or first of all, let me do it somewhere here. All right. Now, if you have price uptrend, higher high, higher low, higher high, higher low. Now, in between this low and this high, you will have series of internal highs and internal lows, internal highs and internal lows like this. All right. So it does not just move in a straight line. You're going to have series of internal highs and internal lows. When you go down to your lower time frame, you will definitely see series of internal highs and internal lows. Yeah, internal highs and internal lows. You're going to see them. All right. So on your higher time frame, you might just on your higher time frame, yeah, you might just be seeing a smooth move. But when you go down to your lower time frame, you're going to be seeing series of internal highs and internal lows. All right. So that is what we're going to be breaking down next. All right. We're going to be breaking down what internal market structure shift. Yeah. Now, look at your left, okay, the bottom left corner of your screen, okay. We have price coming from an uptrend, okay. Higher high formed, higher low. Now, this is not a swing high. This happens to be our swing high, okay. Now, if you notice, we are still in an uptrend. We are still in an uptrend. Don't forget, this is not a swing low. Price came down, okay, and shifted market internally, all right. We have a market structure shift here internally. This is an internal market structure. But we are still in an overall uptrend. The whole trend has not changed yet. Now, most times, this internal market structure shift only signifies that a pullback is about to begin. A bearish market structure shift signals that bullish rally is over and a pullback might start. All right. So when you have this internal market structure shift, most times after a break of structure, you get to find out that what? A pullback begins. Don't forget, the trend has not changed. It just signifies a what? A pullback that is about to begin. Now, the pullback does its own thing. It goes up and down, does its own movement. And then you're going to have another market structure shift that will signify to you that the trend is about to continue. Now, this second internal market structure shift that you will have, yeah? This second internal market structure shift that you will have is at this point now that you're going to be looking to trade and join the trend. I've told you guys that the best way to trade is what? Continuing on the trend direction. So it's at this second internal market structure shift that you're going to be looking to do what? To join the trend to continue going up. Now, this first internal market structure shift, it was showing you, or it was signifying that a pullback was about to start. Now, this second or this other internal market structure shift that happened is telling you that the pullback is over and price will begin to align with the original trend. The bullish market structure shift you have over here signals that pullback rally is over and price will now align with original trend and a swing run will start. So now from this market structure shift, you're going to have a move that will go on to create a new higher high. All right. See, if you're following with me, just send in some fire emoji into the group chat. All right. Send in some fire emoji into the chat here on Zoom. Let me be sure you guys are going with me because I'm actually enjoying the class. So I want to be sure. If you're enjoying the class, send in some emojis. Yeah, I can see that. That's amazing. Smooth solution, covenant. That's splendid. Onuba, I can see you. Jonadi, marvelous. Amazing. I love it that you guys are active. That's splendid. That's very much splendid. All right, so let us keep on going. All right. Now, you must understand, all right, that trading just market structure shift is not all right. You're not just going to trade just market structure shift, all right. Now, in as much as this is a very reliable approach to the market, it can fail you sometimes, all right. That is why you have to use confluences like the higher time frame analysis, supply and demand, liquidity, and premium of discount. If you have your books, you should write this because we're going to be talking about this later on, all right. So you're going to be using confluences. When we talk about confluence, what are confluences? I've explained this in the last class. I told you guys that confluence is when you have so many things telling you the same thing. Let me look for. Okay, I'm going to give the example I gave in the last class. Let's assume you want to be sure that rain will fall. All right. First of all, you have to check: are you in the rainy season? if you're in the rainy season, that is the first confluence. If you want to be sure if rain is going to fall on that particular day you are carrying out this analysis, you're going to have to look up to the sky. Is the sky cloudy? If you have the sky cloudy, then you have two confluences. The first is that you are in the rainy season, and the second is that the sky is cloudy. The third is maybe, all right, is it windy outside? If it's windy, then rain, then it might rain. All right. So confluence is basically so many things telling you that one thing is going to happen. All right. So before you actually treat market structural shift, you have to apply confluences like the higher time frame analysis, supply and demand, liquidity, and premium or discount. All right. So don't worry, I'm also going to teach you guys all these things. King has got your all. All right. So you can see, okay, market structure shifts can actually happen in different ways. Okay, now at this point, we are coming from an uptrend. We had a market structure shift right here, right? Market price shifted, okay, and then signified that the pullback was going to start, all right. And then at this point, okay, you might have thought that okay, another market structure shift happened, so the price will begin to go on an uptrend, and then just before you think of it, boom, another market structure shift happened to tell you that the pullback still continues. All right. Now, it's for you to be able to get something that is solid, for you to be able to know which market structure shift will actually work. That is where you're going to have to bring in higher time frame analysis, supply and demand, liquidity, premium or discount. All right. That's where you're going to have to bring in all these things, because all these things are going to tell you that, hey, this one that happened here is a scam. This one that happened here is fake. This is the one that's going to work. All right. All this is going to tell you. All these confluences are going to tell you. All right. So that you don't have to get caught unnecessarily. Okay. Now you can see this is how market structure shift happen here. You have price going, boom, previous low broken, a pullback starts, another market structure shifts, boom, previous high broken, and then the uptrend continues. All right. So we are going to be looking at something also quite interesting. All right. Now, oh, we're running out of time. 10 minutes to go. Now, you must understand, all right, when a market structure shift happen, as far as it does not break below the previous low, all right, as far as price does not break below previous low, all right, we are still in an uptrend. So just because you see a market structure shift here, it does not mean that the trend has changed to a bearish trend. No, as far as price has not moved below the swing low, the previous swing low, all right, that broke above previous swing high, we are still in an uptrend. Now, if price gets to break previous swing low, it's at this point now we have a market structure shift for a change of trend. All right. But if price gets to trade above it, all right, if we have something like this, then we are still in an uptrend. This market structure shift only signifies that the pullback was about to start. All right. You can see the example right here. Look at them closely. Look at them closely. You have breakup structure, internal market structure shift for pullback. Price did not break below previous low, below swing low, so we are still on an uptrend. On here, we have the same thing. Break of structure, swing low, market structure shift, but in this case, price broke below swing low, so we are on a downtrend right now. All right. Now, let's dive into another interesting thing. Okay, we're going to be talking about structure mapping. Structure mapping. All right. Structure mapping. Now, yeah, you must understand something. All right. Now, this is a very shall I say, it looks very realistic because that is the whole point of the thing. All right. Now, when you have your candlestick forming, I told you guys that with that candlestick have two parts. All right. The two parts of the candlestick are what? The body and the wick. All right. The body and the wick. Now, if you want to identify a break of structure, all right, the first pattern, okay, which I will recommend, all right, I will recommend you use this type 1. You are drawing your break of structure from the wick of the high. All right. So let us assume that this is a higher high. Let's say this is a higher high. All right. Let's say this is a higher high right here. Now, this higher high, you are drawing your structure, or you are highlighting your structure from the wick. Okay. From where the wick ended. So you're drawing it. Now, in this scenario, we had this wick go above this level. Does it mean we have a break of structure right here? No. We only want to see a break of structure when we have a full body close above the wick. You get me? We only consider it a break of structure when we have a full body, when we have a candlestick closing with a body above the higher high. But if the candlestick just goes above it with a wick, this is not a break of structure. This is a liquidity sweep. Hey, Wesley, what is liquidity sweep? Guys, when we talk about liquidity, I'm going to explain what liquidity sweep is. So let's not just dive into liquidity right now. But when we talk about liquidity in our next few classes, I'm going to talk about liquidity sweep. All right. So just know that in a break of structure, we want to see that the structure was broken with a full bodied candle, not a wick. We want to see the candlestick close above the previous high and not just go on inside of it with a wick. We want to see that it closed with a full body. All right. Now, the type 2, which is a more aggressive approach. All right. It's a more aggressive approach. Now, you have a break of structure, or you consider the break of structure when you have price. What is it called? When you have price breaking your previous high with a wick. So you consider that a break of structure, but this is an aggressive what's it called? An aggressive approach. All right. I'm going to tell you where to apply both of them because both of them are important. In as much as this is conservative and this is aggressive, both of them are important. All right. Now in this case, you get to have it as what? You get to have a break of structure when what the hell is this? You get to have a break of structure when a wick goes above it. So you consider that one a break of structure. And then when price goes above the wick that went above the previous high, you also consider it a break of structure. Yeah. So now let me show you where you can get to actually apply all these things. All right. Now let's assume. Now, yeah. Now at this point, okay, at this point, we want to be using type 1. All right. Don't forget, now type 1 is when we consider the break of the previous high with a full bodied candle. We do not want to see wicks, or we do not want to consider wicks. All right. So at this point, we consider type 1. All right. But then when we get to talk about this internal, when we get to talk about this internal structure, yeah, when we get to talk about this internal structure, we can actually consider what type 2. We can actually consider type 2. All right, for this internal structure. So now when we are looking at internal structure shifts, all right, we can say, okay, we can then apply the wick, all right, which is this aggressive approach here. We can then say, okay, even if we see a wick closing below the low, then we can actually consider an internal market structure shift. But then if it's the overall trend, all right, if it's the overall trend, like this one here, we want to make sure that price does what? Breaks above it with a full-bodied candle. Does that make sense to you? All right, so now at this point where we have a major structure, okay, where we have a major break of structure, we want to consider type 1. We want to consider type 1. All right. So we have just about 3 minutes for this class to be over. So I will send the new link to the group chat now. Okay, and then I'm going to show you some live chat examples. Yeah, I'm going to show you some live chat examples, and then we will call it a day here. All right. So I'm just going to send you guys I'm going to send a new link right now. So I'm going to end this call right now and send you a new link. So I'm going to see you in my next class.